Let's see on my live. Yeah. So good afternoon. It is Tuesday afternoon, and I'm here to talk to you again about best practices using QuickBooks, your accounting. I mentioned a while back that I had 15 best practices I wanted to talk about. I'm doing this in bite-sized pieces so that you're not overwhelmed and you will learn something from this instead of having it go whoop like that. I know that, well, does anyone wonder if they're doing it right? I have plenty of clients that ask me, how do I know? I'm winging it. I'm just trying to figure this out. And so I'm here to hopefully give you a little insight to that. So best practice, we've done 6 so far. This is going to be number 7. Is keep independent contractors independent. This is such a big deal. I can't tell you how many clients I have that have to deal with this. And let's say it's a really costly mistake when you treat an independent contractor or what is really an employee, and you try and put them in as an independent contractor, and that happens because the contractor, number one, doesn't want to pay their side of the taxes. Employers don't want to pay their side of the taxes, and it can be a really costly mistake. And when it tends to show up is, number one, when an individual gets hurt on the job. That's the big deal. They get hurt on the job, and if they're a contractor, then that really isn't your problem. If they're a true contractor, if they're an employee, yes. The other thing is when you no longer need their services, then they decide, I think I'm going to go file unemployment. And this is when things like this come out. If you are found to have misclassified those employees, contractors, it can be a really costly mistake because you can have to pay back taxes, back workers' comp, payroll taxes, penalties, interest. It's not good. And this doesn't come down on the contractor, it comes down on the employer. So, and just because you have a contract that says independent contractor agreement, that does not make them a contractor. The IRS has 20 specific questions to determine contractor status. I'm not going to go through all 20 of those. I'll give you the highlights. Happy to send you that list if you need it. Number 1, are they in business for themselves? Do they provide services for the general public? Do they set their own schedule? Do they bill your company? And what I mean by that is, do they invoice you? Many times they don't want to, but you definitely want them to be sending you an invoice if they're a contractor. I have a lot of clients that they will pay their contractors without even getting an invoice from them, and that's a big no-no. And then the other thing is, do they carry their own professional and personal liability insurance for their company? If they're found to be a contractor, then what you want to do is you put them in QuickBooks as a vendor. Number 1, be sure and get a signed W-9 underlined prior to paying them their first payment. And the reason I say that is because at the end of year, when you're trying to send them a 1099, you need to have their address, and you need their social security number or tax ID. And who wants to give you that? Because they don't want to pay taxes, so they figure if they don't get a 1099, then they're free and clear, and that's not the way it is. So be sure and get that prior to making that first payment. Get a W-9, and then make sure that you pay the person or company that is listed on that 1099 on the W-9. Do not let them tell you, pay my wife, or would you make the check out to my cousin or whoever else. Make sure you make it out to them. Okay, best practice number 8 is officer compensation. Make sure that is reasonable. So small business owners have several options on their the way they're going to be taxed, and that is a sole proprietor. Wow, I am sorry about that. They can be taxed as a sole proprietor, partnership, an S Corp, or a C Corp. If you're taxed as an S Corp or a C Corp, you no longer can take draws, partner distributions. You can take them, but that is not the only method of payment. You now have to pay yourself a salary, and that has to be reasonable compensation. And how you determine what reasonable compensation, there's a few ways. And just so that you know, an LLC is not a corporation. That is a limited liability company, not a corporation, and that just provides an umbrella of protection, but it does not change the way the entity is taxed. And sorry, I have made notes here because I don't want to miss out on any of this. So let's see. As to the reason, whether the compensation is reasonable or not, there's a few factors to determine that. And one is your compensation commensurate with your skills and knowledge. How does it compare to the rest of your staff? What percentage are you taking as salary as opposed to draws or distributions? And then the other thing, which a lot of people forget to consider, is if somebody paid you that amount of money, would you go work for them? So if someone gave you $10,000 to do the job you're doing, would you go work for them? Answer's probably not, which means that's probably not reasonable compensation. But this, I highly recommend discussing this with your CPA, and they will help you determine what is a correct split between payroll and distributions. The last best practice is best practice number 9, which is reconciling your accounts. Pretty much all accounts that are on your balance sheet should be reconciled, which includes but not limited to checking account, savings account, petty cash, accounts receivable, your credit card accounts, your accounts payable, line of credit, your loans. So by reconciling, what that does is it makes sure that you've recorded all your expenses. It makes sure you haven't duplicated expenses. You get your tax deductions in the correct year. Let's see what else. Helps you figure out who you owe money to, because you're reconciling those payables and receivables. Who owes you, who you owe money to. So you can be more proactive in getting paid, etc. And then also it makes sure you get the tax deduction for interest paid. The last thing I want to mention here is a number of clients, they will have their car payment. And they'll include that car payment, and I won't get into whether that's a correct thing to do or not, but they include their car payment and they put the entire payment into auto expense. Big no-no. Big no-no. And because that vehicle, the whole thing is not expensable. You have to depreciate that vehicle. What you can take off as the deduction in that year is the interest that you've paid. So you need to split that payment into principal and interest, and that gets done. It's a split between your expense account and your fixed asset account. So that's getting a little bit too much, but you need to be aware that the whole thing is not auto expense. So in summary, keep your independent contractors independent. keep officer compensation reasonable, and be sure and reconcile all your accounts. I hope this was helpful. If any of this information you want more detail, please let me know. The other thing that I did want to offer you is I have a 2020 guide to tax deductions. That includes, it talks about the teacher classroom deduction, the self-employment tax deduction, and including all the limits, and which also includes your home office. Many of us have gone into home offices, as you just saw. The dog had to come in and out. And so what percentage, if any, is deductible? And mortgage interest, etc. So if that is helpful, let me know. I am more than happy to send you that guide, just to kind of give you a heads up for what's coming. So thanks for joining me, and I will talk to you tomorrow. Bye.